Hello and welcome to CryptoCore, your navigator in the world of cryptocurrency. It's 00.01 UTC on Wednesday, December 10th, 2025. Over the next half hour, we'll be breaking down the biggest stories in crypto from leading global sources over the last 24 hours, focusing on the market as a whole and, of course, Bitcoin and Ethereum.
It's been a very strong session, driven by a mix of institutional news and macroeconomic anticipation. Right now, Bitcoin is trading at $92,706. That's up about 2.31%. But the real story is Ethereum, which is at $3,320, a massive 6.31% jump in just 24 hours.
Wow, that's a huge divergence. Ethereum is really outpacing Bitcoin there. It feels like those numbers are a direct reflection of the institutional interest we've been tracking. We've definitely got to dig into the why behind that surge today. We have a packed agenda for you, a total of 15 deep dives into major global market trends, regulatory updates, and in-depth analyses of Bitcoin and Ethereum. Now, at CryptoCore, we stick to a strict rule. We only cover articles published by major outlets within the last 12 hours.
Right, and because we produce this every 12 hours, you might see us revisit a topic. But that's intentional. The story often evolves, with more details or a new angle emerging just hours later. Our goal is to track that evolution for you.
Exactly. We're prioritizing depth and timeliness above all else. And you'll want to stick around because later in the show, we've got a massive story about the CFTC's new Collateral program, a huge step for institutional adoption.
I think today's key takeaways really boil down to three things. First, the Bitcoin market is undergoing a structural shift. We're seeing retail investors pull back while institutions are buying up supply, which is creating a potential supply shock scenario. Second, all eyes are on the FOMC meeting. Rate cut expectations are already priced in, which creates its own set of risks.
And the third?
The third is that landmark decision from the US CFTC. They have officially approved Bitcoin, Ethereum, and USDC as collateral in derivatives markets. This is accelerating crypto's integration into the mainstream financial system much faster than I think anyone predicted.
It's going to be a fascinating discussion. Before we jump in, if you could take a moment to hit that like, subscribe, and notifications button, it really does help us out a lot. Okay, let's get into our first lead story. First up, from outlets like Crypto.news and DL News, the big event of the day. The FOMC meeting has officially kicked off. The market is pricing in a very high probability of a quarter-point interest rate cut. The analysis suggests that Bitcoin, holding strong above $90,000, is already trading as if this cut is a done deal. Does that mean investors are getting ahead of themselves?
Well, they're certainly optimistic. Market participants are always, extremely sensitive to any dovish signals from the Fed. If we get the friendly language they're expecting, it could definitely trigger a short-term rally. But the flip side of being priced in is the risk. If the Fed comes out hawkish, if they stay firm on their tight policy, that could trigger a significant sell-off instead of the buying spree everyone is waiting for.
So what's the view looking further out, say, into the medium and long term? Is this rate cut hope expected to carry into 2026?
Yes. The general consensus among analysts is that 2026 should be a bullish year, especially with a new Fed chair potentially steering policy. But, and this is a big but, there's also a strong note of caution. If macroeconomic conditions worsen, or if political uncertainty heats up around the 2026 U.S. midterm elections, that could easily lead to a market correction. So it's less about today's hope and more about next year's actual policy execution.
Okay, our second story is one of those moments that really feels like a turning point for the industry. This could be the most significant step yet toward integrating crypto into the heart of the traditional financial system. Crypto Potato and Cointelegraph reported on December 9th that the U.S. Commodity Futures Trading Commission, the CFTC, has launched a pilot program.
And this program is a game changer. It allows for tokenized cryptocurrencies to be used as margin collateral in derivatives markets.
So this means crypto is no longer just an asset to be traded. It's now being officially recognized as a legitimate form of value collateral within the regulated U.S. financial system.
Exactly. This move brings these tokens into the operational framework for clearing futures and swaps. It essentially places them on par with traditional forms of collateral, like U.S. Treasuries or gold. That's the key takeaway here. It's about achieving an equivalent status.
So which assets made the cut for this initial pilot program? And maybe more importantly, why were they chosen?
For the first 3 months, which will be under very strict monitoring, only 3 assets are permitted. They are Bitcoin, Ethereum, and USDC. The rationale is pretty clear. Bitcoin and Ethereum have the market dominance and, critically, the deep liquidity required. And USDC is widely seen as the most transparent and regulation-friendly stablecoin out there.
It's also very telling what was left out. Major altcoins like XRP and Solana were excluded from this first phase. It really shows the CFTC is being selective, prioritizing stability and regulatory clarity over just market cap.
That's a perfect summary. They're demonstrating that their primary criteria isn't just size, but how reliably an asset can function within a compliant framework. It's no surprise that industry leaders like Circle and Coinbase are applauding this. They see it increasing capital efficiency and reducing friction. This is the start of making the entire crypto market more efficient.
And a quick reminder, if you're finding this deep dive helpful, you can support our work by hitting the heart-shaped thanks button below the video to buy us a coffee. Every bit helps us continue our data collection and analysis. Moving on to our third story. According to Crypto Briefing, there's some movement on the legislative front. Senate Democrats involved in negotiating the bipartisan crypto market structure bill held a private meeting after receiving a compromise proposal from Republicans.
Right. And this is significant because the main roadblock for years has been partisan disagreement over consumer protection. Democrats have been pushing for stronger investor safeguards, while Republicans have prioritized fostering innovation. This private meeting, even if it doesn't lead to an immediate breakthrough, shows that the efforts to break that deadlock and clear up regulatory uncertainty are continuing behind the scenes.
Okay, fourth, a quick look at the broader economy. Former President Trump mentioned he might lower tariffs on some goods while raising them on others, arguing that his tariff policies are successfully bringing companies like automakers back to the U.S.
And that kind of policy uncertainty goes beyond just trade. From a macroeconomic perspective, corporations are warning that even existing tariffs could lead to price hikes because of inventory shortages and supply chain issues. This kind of volatility in global trade policy inevitably impacts risk appetite in financial markets, which of course includes crypto.
Now for our fifth story. And this one has some of the most fascinating data points we've seen, really highlighting a structural change in the Bitcoin market. CoinSpeaker and Cointelegraph report that over the last year, more than 400,000 BTC have left exchanges. This has pushed exchange reserves to a historic low.
Which points directly to a potential supply shock, a very bullish long-term signal. It means institutions and large funds are buying Bitcoin with the intent to hold it for the long term, moving it into self-custody. But there's a really interesting counter-narrative happening at the same time. The amount of retail-sized Bitcoin flowing into Binance has collapsed to a record low of just 400 BTC per day.
And the number of wallets holding more than 0.1 BTC has also dropped for the first time in 2 years.
Exactly. So what you're seeing is a fundamental shift in market participation. Institutions are absorbing supply, while smaller retail investors are either losing interest or perhaps moving their capital into indirect investment vehicles like the ETFs.
So what's the primary reason for this retail exit, do you think?
It could be a mix of things. Maybe fatigue from the market volatility, or maybe they're just shifting their strategy to these new, easier-to-access institutional products. But the crucial point is that the institutional accumulation is more than offsetting the retail outflow. It's why many analysts are still calling for a potential rally to $100,000 by Christmas based on this supply shock dynamic alone.
Okay, story number 6 provides a bit of a short-term counterpoint to that bullish long-term view. A Cointelegraph analysis suggests that Bitcoin's recent price action has formed a bear flag pattern, with the technical target down around $67,000. This suggests that while the long-term structure is strong, there's some real downward pressure in the immediate future.
That's right. The technical analysts see the price losing momentum as it approaches key resistance levels. And adding another layer to that, Crypto has pointed out a consistent pattern of price dips occurring right around the U.S. market open. They're raising the possibility of market manipulation or algorithmic selling by high-frequency trading firms.
So if the market does show weakness in the short term, and let's say that $90,000 level breaks, what's the next critical area to watch?
The key support level to hold is $89,000. If that holds, some charts suggest a rally to $96,000 is still possible. However, most professional traders remain skeptical about a clean break above $92,000 right now. It's created this real split in market sentiment. You have some long-term forecasts that are interpreting all of 2025 as a bear market in disguise, just a consolidation phase before a major rally to $150,000 in 2026.
So the long-term and short-term views are almost completely at odds. Now for our 7th story, let's turn to Ethereum. which, as we said, is really leading the market today, and it seems to be all about frantic institutional interest. NewsBTC and DL News are reporting that BlackRock has officially filed for a staked Ethereum ETF.
And the staked part is critical. This goes beyond a simple spot ETF. It shows a powerful institutional demand for yield-generating crypto products. It positions Ethereum not just as a store of value like Bitcoin, but as a productive income-generating asset for institutional portfolios. A staked ETF would allow investors to get exposure to ETH while also earning staking rewards.
And BlackRock isn't the only big player making moves.
Not at all. Bitmine, led by Tom Lee, just purchased another $435 million worth of ETH. They've stated an incredibly ambitious goal to eventually control 5% of the entire Ethereum supply.
For a single entity to aim for 5% of the total supply, that signals an immense level of confidence in Ethereum's future utility. What are the on-chain analytics showing? Are the whales following suit?
They absolutely are. So-called smart whales have opened more than $425 million in new long positions. It's just overwhelming evidence that Ethereum is solidifying its place as an essential, high-yield component of institutional portfolios.
Let's stick with Ethereum for story number 8, but shift to a more technical discussion. According to NewsBTC, ETH's price is consolidating below a resistance level at 3180 after its recent rally. But Crypto highlighted a really interesting proposal from Vitalik Buterin himself. He suggested creating a gas futures market.
Yeah, this is an attempt to tackle one of Ethereum's longest-standing problems, the unpredictable volatility of gas fees. The idea is to create a financial product that would allow users and developers to hedge against spikes in transaction costs. In theory, it increases predictability, but the reaction from experts is mixed. Some worry that a futures market could itself become a target for manipulation.
But the attempt to solve this core issue with a market-based solution is noteworthy in itself.
It is. It shows a commitment to maturing the ecosystem and addressing user pain points, which is a positive sign regardless of whether the specific idea gets implemented.
Ninth, let's talk about market growth and real-world integration. An interesting analysis has emerged. Even though the total market cap of stablecoins like USDT and USDC is hitting all-time highs, that massive pool of liquidity isn't translating into explosive price gains in the spot market. Why is that?
It's all about where that liquidity is flowing. A large portion of that capital is moving into the derivatives market rather than spot buying. But perhaps more importantly, we're seeing a significant increase in the use of stablecoins for real-world payments and remittances. This is actually evidence of deeper adoption crypto liquidity is seeping into the real economy.
And we're seeing that reflected in the moves of traditional financial companies like Western Union.
Right, precisely. Western Union is planning a stable card targeted at high inflation markets. At the same time, Circle is expanding USDC adoption through a partnership with Bybit, and even Tether is diversifying its investments into things like AI and humanoid robotics. The stablecoin issuers are thinking beyond just crypto trading now.
Okay, our 10th point is a roundup of general market and exchange trends. Crypto Potato is highlighting the ongoing debate between centralized exchanges, CEXs, and decentralized exchanges, DEXs, basically the classic trade-off between convenience and control.
And we're seeing major platforms expand their reach. Robinhood is growing its crypto services in Europe and planning a move into Indonesia. This shows that traditional brokerage platforms now see crypto as an essential offering. And related to that, the CIO of Bitwise predicts that as the market gets more complex, crypto index funds are going to become extremely popular in 2026.
But it's not all good news across the board. The NFT market, in contrast to the broader market's growth, seems to be struggling.
It is, yeah. Cointelegraph reports that the NFT market is in a deep slump. Monthly sales have hit a yearly low, and the total market cap has fallen by 66%. It really suggests that capital and attention are consolidating into the blue-chip assets like Bitcoin and Ethereum, which are being driven by institutional flows, while more experimental sectors are in a cooling-off period.
For our 11th story, we turn to the poster child of corporate crypto strategy. Strategy, formerly MicroStrategy. The company just bought another 10,624 BTC for $962.7 million. They did this even as the premium of their stock price over the net asset value of their Bitcoin holdings is shrinking.
CryptoSlate has a great analysis of this, calling it the end of the infinite money glitch arbitrage. For a long time, their stock traded at a huge premium simply because they held Bitcoin. That premium is fading, which challenges the entire strategy. CEO Michael Saylor is sticking to his accumulation plan, even with the risk of being delisted from the MSCI index.
But major financial institutions like Standard Chartered are now sending out warnings about this corporate accumulation strategy. What's their specific concern?
Their argument is that current valuations no longer support these massive corporate Bitcoin buys. They believe the trend is likely coming to an end. And there's data to back up that concern. A Bloomberg report noted that the median stock price for digital asset treasury companies fell by 43% in 2025. It feels like the entire corporate treasury strategy is really being put to the test.
Number 12, we have the emergence of another major institutional player. 21 Capital, which is backed by SoftBank and Tether, has begun trading on the New York Stock Exchange under the ticker XXI, and they hold over 43,500 Bitcoin.
This is a really big deal. It means there's another major publicly traded vehicle for Bitcoin exposure, a direct competitor to MicroStrategy. What's interesting is that just before their listing, the company moved a massive amount of BTC into self-custody. This seems to be a direct response to market demands for transparency and security.
There was some market chatter about that large move, wasn't there?
There was. Some feared it was a prelude to selling, but CEO Jack Mallers clarified that it was all part of their proof of reserves and a transition to a more secure custody model. It shows how institutional practices around holding Bitcoin are maturing.
13th, we'll take a quick tour of the global regulatory environment. Starting in the UAE, Circle has secured an operational license in Abu Dhabi, further cementing the UAE's status as a growing crypto hub.
Over in Europe, we're seeing two opposing forces at work. On one hand, authorities busted an $815 million crypto fraud ring, showing a crackdown on illicit activity. But at the same time, the major French bank BPCE is starting to offer crypto trading services to millions of its customers. So enforcement is getting tougher, while mainstream adoption through banks is accelerating. It's a bit of a paradox.
And what's the latest from South Korea? Any progress on the regulatory front?
Well, South Korea's Virtual Asset Committee has paused its activities due to some political turmoil. However, in the wake of the Upbit hack, there's a strong push to implement stricter liability rules for exchanges. It suggests that even if high-level regulatory work stalls, the push for greater user protection and exchange accountability continues to move forward.
For our 14th story, we head to Japan. The country's financial services agency, the FSA, is planning to mandate that crypto exchanges maintain a liability reserve fund. This comes after the DMM Bitcoin theft and is designed to ensure customers are compensated in the event of a hack.
It's an attempt to bring crypto exchange regulations more in line with the standards for traditional securities. But the really fascinating piece of news out of Japan is from a recent survey. It found that the main reason Japanese investors are leaving the market isn't price volatility, it's the complicated tax requirements.
How are crypto profits taxed there currently?
They're classified as miscellaneous income, which can be taxed at a rate as high as 55%. To encourage investment, the FSA is now seriously considering reclassifying crypto gains to be taxed at a flat 20% rate. If that tax reform goes through, it could unlock a huge amount of liquidity in the Japanese market.
And for our final story, number 15, we look to Hong Kong and its ambition to become a leading crypto hub. The homegrown crypto exchange, Hashkey Group, has started its IPO subscription in Hong Kong. They're aiming to raise $215 million and are expected to start trading on December 17th.
This is a huge milestone, the first IPO of a local crypto exchange in Hong Kong. It's a massive signal of the city's commitment. And in parallel, the Hong Kong government has launched a public consultation on adopting the OECD's Crypto Asset Reporting Framework, or CAROF. Their goal is to automate cross-border tax reporting by 2028, which clearly shows their intent to integrate crypto assets into the transparent global financial system. So to sum up today's market, it was really driven by two powerful forces: regulatory clarity and institutional inflow. The CFTC's decision to approve Bitcoin and Ethereum as collateral is like hitting the accelerator on crypto's integration into traditional finance. And the potential for a Bitcoin supply shock, despite the retail pullback, continues to strengthen the long-term bullish case.
And Ethereum was really the star of the show today. BlackRock's filing for a staked ETF and the aggressive accumulation by whales make it clear that Ethereum has moved beyond being just an altcoin. It's now viewed as an essential yield-generating component for institutional portfolios. Globally, from Japan's potential tax reforms to Hong Kong's landmark IPO, the message is clear. Crypto is no longer a separate system. It's becoming an inseparable, regulated part of the global financial landscape. And that's all the news we have for you today. If you enjoyed our deep dive, we'd appreciate it if you'd subscribe, like, and turn on notifications.
CryptoCore, your navigator in cryptocurrency, is committed to bringing you the fastest, most accurate, and in-depth analysis of the latest trends.
We'll be back next time with more insightful information. Thank you for tuning in.
For those of you who want to dig deeper, the two main articles we referenced in our analysis today were from DL News, published on December 9th, 2025, titled Fed Cut, Already Priced In with Bitcoin at $90,000. Why 2026 Should Be Bullish, and from Cointelegraph, also published on December 9th, 2025, with the headline, The CFTC Just Authorized Bitcoin, ETH, USDC Only for U.S. Leverage, Leaving XRP SOL Stranded in Risky Limbo.
You can find more detailed information on these topics by visiting the websites of those respective news outlets.